for your time today. Let's move on then and invite our alpha manager for the day, Harish Krishnan, Senior Vice President and Equity Fund Manager at Kotak Mutual Fund, is now joining us. Harish, good afternoon. Thanks a lot for joining us. Now, the markets had a big rally over the last 2.5 months, but are you sensing some kind of, warning signs in this market? The way, the B group, C group, even Z group stocks started to move up. Are you noticing any warning signs, or you think that's par for the course?
Good afternoon, Anuj. I think your observation is pretty spot on. If you take a slightly more larger view, in the month of March, global markets, and I'm talking about both bonds and stocks, they lost close to about $30 trillion in a single month. And over the course of the last 2.5 months, they have recovered almost 75 to 80%. The bonds have recovered and gone on to more record highs, and equity markets have recovered almost 75 to 80% of what they had lost out. And in that sense, the Indian market has been no different. Effectively, if you look at the Indian markets and think about, say, Nifty X banks or X financials, we are already, at record highs. So barring this one group, which is obviously a very large constituent of indices, we have pretty much made a strong recovery. And the heartening thing is, I think, from the lows, even the broader markets, both mid caps, small caps, of course, in markets, you will always have the smaller segment, which obviously makes significant moves in times like these that people set up and take notice on. So effectively, the way we are looking at it is, I think we are taking the following insights from this kind of a market reaction. First, we think that the lows that we made in March, globally as well as in India, will now hold. There is enough confidence in central banks, wanting to stem any declines. So that is definitely a positive. Second insight that we draw upon is that now that the assets have reflated back, central banks have no particular incentive to further keep improving liquidity. Yes, liquidity is benign. It will continue to be the same. But what we define as, say, liquidity impulse, which is, incremental liquidity, how it is moving, that I think kind of ebbs, which will have important ramifications from a liquidity, given the fact that a lot of this deflation has been purely on the back of flows. And the third insight is, from an Indian context, clearly we are sensing that, on the real economy, or stocks belonging to the real economy potentially are more raring to go, given their under ownership, etc., compared to the stocks which are, in the financial sector, and potentially maybe even on the FMCG side, on the consumer side, barring possibly the food side in the FMCG space. So this is broadly our sense of how we are looking at markets from a slightly more medium-term perspective.
Okay. Harish, good afternoon. Surabhi here. If I could ask you to expand on that last point, this sort of view on real economy stocks. I mean, I think when I look at your portfolios, while banks form the large share, I do see a lot of cement names coming up. So if you could expand on this theme, what do you mean specifically when you say real economy? Because the sector has suffered from under ownership and underperformance for almost a decade now.
That's right. Surabhi, the nuance that we are drawing comfort on is most sectors in the real economy have consolidated significantly over the last 3-4 years. You spoke about cement. Today, the top 5 cement groups control about 80% of the overall capacities. We've seen, for example, in telecom, clearly what consolidation means to the overall profit pools that can potentially come and the pricing power that comes through. Even if you move into capital goods, light engineering, a lot of capacities have gone out of business purely because demand has been so anemic. So for us, we are drawing comfort on the fact that yes, on the supply side, things have pretty much, the stronger hands are the only ones remaining in business. Everybody else has kind of packed his bags and gone off. The second thing that we're drawing comfort is that the cost of capital is coming down quite significantly. In India, we've seen The wholesale markets kind of reflect that. We are yet to see it in the actual lending or onward lending by the banks and NBFCs to the real economy. But our sense is that it is a question of time. For sure, now there is risk averseness, but are we going to see that person or 12 months down the line? Our guess is we are going to see actual flow through of credit also going through. A combination of both of these, along with the fact that under ownership, as you rightly pointed out, makes for a very strong underpinning for a change of trends that we've seen over the last almost 5-6 years, wherein you had a very polarized market led by, say, consumer staples, led by a few financial names. And now we think it kind of opens up to a lot more sectors. Of course, we need to be far more selective. Business conditions are very tough. There's no shying away from that. But if you've got in the right business groups, we somehow sense that over the course of the next 3-5 years, the real economy stocks should potentially do much better.
Okay, fair enough. You have a lot of exposure to insurance, both life insurance and general insurance, Harish. And this is one sector which is holding out even in a weak market, or was holding out even in weak market. Do you think this post-COVID world will see further re-rating of some of these insurance stocks?
So our bet, Anuj, is primarily on the fact that, given the fact that avenues for spending have come off quite meaningfully, obviously in a lockdown scenario and even otherwise, we think that the top 25-30% of households savings will actually start going up. We think that, at least, and again, I'm talking of the near term of, say, the next 6 to 12 months, real estate spending, etc., may take a backseat in these kind of nebulous. And in that kind of a yardstick, we somehow sense that, as savings goes up, we are going to start seeing investors start looking at, and clearly we are seeing in terms of, say, manifesting in terms of even action on the equity markets, wherein, we've seen a whole bunch of retail investors coming in. Similarly, we think insurance will likely be a key beneficiary as investors and savers start looking at their overall bank accounts and start seeing where else they can deploy, especially in an environment where their interest rates are coming down quite significantly. Of course, this is a journey. It's not something that'll happen right away. But we think on the liability side, both in terms of insurance, general insurance, again, a very underpenetrated sector, even in terms of, say, cards and payments, where typically these are transaction oriented. After a brief lull, obviously given the lockdown, once things start normalizing, we think that these will be the 3-4 areas where financial services will benefit the most, especially given there are no worries on the asset quality side that most of the lenders today, the worry is all about.
Okay.